Okay, let's dive right into this explainer. We're going to peel back the layers of Bitcoin's recent, frankly massive surge. And you know what? We're going way beyond those basic shiny headlines today. Because, ironically enough, the absolute biggest drivers for this decentralized crypto asset right now, they're actually coming straight from traditional government finance. Crazy, right? So let's figure out if the old crypto rules still apply, or if we're literally witnessing a fundamental shift in how this whole asset behaves. To really set the stage for us, we need to talk about one very specific number, $71,507. On August 20th, 2026, Bitcoin smashed back above that psychological $70,000 threshold, hitting this exact intraday high. And honestly, that was its highest level since way back in early June of that year. But what makes this so wild isn't just the number itself, it's the sheer velocity of the move. We're talking about an explosive 10% gain in literally just 2 days. That right there is a major market story. And let me tell you, it instantly brought a ton of excitement roaring back to the trading floors. And almost immediately, that massive surge brought one of Wall Street's boldest calls right back into the spotlight. You see, Standard Chartered has been sticking to this really aggressive $100,000 year-end target for Bitcoin. But that raises the central mystery we're unpacking today. Is this recent push past $71,000 a durable, lasting shift in market structure? Like, is this the true runway to 100 grand? Or are we just looking at a short-term balance in a seriously complicated market? Well, to figure out if that 100K target is actually realistic, we really have to contextualize where we've just been. It's been a total roller coaster. Remember that massive peak of roughly $126,000 back in October 2025? After that, the market suffered a brutal grinding trough all the way down to $59,000 by June of 2026. So while this recent August rebound up to $71,500 is super impressive, you gotta remember there's still a huge gap to close. Making up that final 40% to hit $100,000 is gonna require some serious, sustained momentum. It is absolutely possible, but it's for sure not automatic. Section 1. Beyond the crypto news. Okay, so here's the thing. If you're only looking at crypto exchanges to understand what Bitcoin is doing, you are totally missing the real story. The actual catalyst is this: $4 billion. The US Treasury very quietly announced plans to basically double the size of certain long-dated government bond buybacks. They bumped them from $2 billion up to at least $4 billion. Now, you might be wondering, why on earth does a quiet traditional Treasury bond operation matter to a crypto trader? Well, it triggers this massive ripple effect across the entire financial system. It's like a giant row of dominoes. First, by buying more bonds, the Treasury effectively pushed borrowing costs lower. And when the bond market calms down and capital suddenly becomes cheaper to get, what happens? Investor appetite for risk absolutely spikes. And what is the most famous risk asset on the board right now? Bitcoin. So that improved macro liquidity basically provided the absolute perfect fertile environment for this rally to take off. But macro liquidity wasn't the only external factor at play here. At almost the exact same time, we saw a major policy catalyst. President Donald Trump held a meeting with cryptocurrency executives at the White House, and he urged Congress to advance legislation favored by the digital asset industry. Now, for years, the lack of clear rules has been this massive hurdle for mainstream financial adoption. So any signal of a potentially supportive policy environment acts as a super powerful psychological booster for the whole investment thesis. Section 2. Is the cycle broken? Now, this brings us to a really deep structural tension happening in the market right now. Historically, Bitcoin is famous for its wild boom and bust phases, but that rigid cycle might actually be dying out. Just think about it. The previous cycle ended with an absolutely devastating 77% peak-to-trough collapse. But this current cycle, the drop from that $126,000 peak down to the $59,000 low, was only 53%. I mean, sure, that's still painful, but it's unusually shallow compared to Bitcoin's history. The asset is just behaving fundamentally differently right now. Section 3. The new institutional era. So, why are we seeing this shallower decline? Well, the old market was completely defined by retail speculation, sky-high leverage, and crypto-native capital. It was volatile, it was jumpy, and it was super prone to panic. But the new market? The new market is defined by Wall Street. Thanks to spot ETFs getting approved in early 2024, we now have massive institutions and macro funds buying in. Everyday investors don't even need to remember a complicated crypto wallet password anymore. They literally just use our standard brokerage account. This whole new class of investors, along with this massive ETF pipeline, is acting like a giant shock absorber during market sell-offs. Section 4. Bull, Base, and Bear. Now, a shallower decline doesn't guarantee a rocket ship straight to the moon, right? We've got three ways this could play out. In the bull case, if we get sustained institutional demand and that sweet macro liquidity, that $100,000 target is actually highly plausible. But then there's the base case. This suggests more of a choppy consolidation, where buyers step in to absorb dips right around that $70,000 mark. And please don't ignore the bear case. If inflation stays sticky and those Treasury yields start to spike again, ETF demand could totally dry up, which would trigger a sharp correction. You have to remember, this market is now highly, highly sensitive to the broader economy. So to empower you as you watch all of this unfold, here is your specific checklist of macro indicators to keep an eye on. First up, watch if Bitcoin can actually hold its ground above $70,000. Second, keep a really close eye on Treasury yields. Remember that $4 billion buyback we talked about? Borrowing costs seriously matter. Third, track the institutional and ETF flows. Basically, is the new market still buying? Fourth, keep watching the crypto regulation coming out of Washington. And fifth, monitor leverage and liquidation activity. All of this proves, once again, that the next big Bitcoin move is probably going to start in the traditional financial system, not just on a crypto chart. Section 5. The ultimate $100,000 test. So, what does this all mean? Well, Bitcoin has officially transformed from a rogue digital asset into a traditional, liquidity-driven macro asset. And that leaves us with a pretty provocative thought to end on. Even if supportive liquidity pushes this market all the way to $100,000, if the bond market later reverses, what happens after $100,000? True market maturity means Bitcoin is now completely at the mercy of global interest rates. Reaching a big